Welcome. Welcome, everyone. Thank you so much for joining us this evening and participating in our fireside chat, Special Purpose Acquisition Companies, What's Behind the Boom, hosted by the Frank G. Zarb School of Business at Hofstra University. I'm Janet Lenaghan, and I have the great privilege of serving as Dean of the Zarb School. And I also have the great pleasure of moderating our discussion this evening. And today you will gain valuable insight into special purpose acquisition companies. While SPACs have been around since the 1990s, they have grown in popularity over the last few years. There's even a rap song about them, but there's also a lot of misinformation about them as well. And we are extremely fortunate to have two experts here tonight to help us better understand the boom behind the growth of SPACs. And what's even better is both of the experts that are joining us this evening are Zarb alumni. Doug Maine is a senior advisor at Brown Brothers Harriman. In this role, he assists in sourcing, investment evaluation, transaction execution, and provides post-investment value-added oversight to BBH Capital Partners portfolio companies. Before joining Brown Brothers Harriman, Doug served as CFO for IBM for 7 years. Before that, he spent 20 years as CFO with MCI Communications, which is now a part of Verizon. Doug serves on the board of directors of Noble Systems Corp., Acreage Holdings, and R4 Technologies. He is an executive in residence for Columbia University School of Business and chairman of the Zarb Advisory Board. He earned his undergraduate degree from Temple University and an MBA from Zarb. And he is currently serving as chairman and CFO of a newly formed SPAC in the tech, media, and telecom space. A strong supporter of the Zarb School and a great mentor to me personally. Please join me in welcoming Doug Maine.
Thank you, Janet.
Our other expert is Jenn Calabrese, who serves as the managing partner at Calabrese Consulting, LLC. And we are fortunate that she's also an adjunct associate professor of accounting at the Zarb School. She started her financial career working for KPMG, amassing knowledge that would guide her life's work, with deep expertise that stems from her tenure on both the client and audit sides. Jenn founded Calabrese Consulting in 2012, applying a hands-on approach that exemplifies her dedication to the craft. Jenn earned her BBA in accounting and psychology from Hofstra. Please join me in welcoming Jenn Calabrese. We are indeed very fortunate to have both of these alums with us today, sharing their knowledge and expertise. And I know you will have many questions. Unfortunately, the chat feature, if you notice, probably isn't there on your screen. We had a little technical difficulty. So we're going to do this the old-fashioned way. And so we're going to use the raise hand function when we get to the Q&A. So jot down your questions and be ready to fire away once we get to that point in the event tonight. But let me first begin with a few questions that I have for the panelists. And so, Jenn, I'm going to start with you. As a financial consultant for SPACs, can you provide an overview, really the basics of what a SPAC is, how it works, and for a private company, how does going public via traditional IPO differ from merging into a SPAC and becoming a public company that way?
Sure, Janet, thank you very much. To start out with a SPAC itself, the very basic definition of it, it's a special purpose acquisition company. So what does that mean? These are companies that are formed with the sole purpose of finding a target company to acquire. So they initially are formed with a capital investment from their founders, and then the founders then take that vehicle and actually bring it public through an initial public offering. They will raise funds in that initial public offering and then take those funds and actually invest them in certain securities that are invested in US government securities. That money will essentially sit there for the duration of the SPAC. And while it's in that account, the SPAC has a limited life. For example, for the most part, let's say about 24 months, during which that period of time, they have to find a target company to acquire. Once they find that target company, they then present it to their stockholders for a vote to determine if this is a viable acquisition. The stockholders will vote to approve or not approve this acquisition. And then at that point in time, they will take that company public, and that company will then become the new public company going forward. So that is a very, very basic purpose or explanation of what a SPAC is. From a perspective of going IPO, whether you're the traditional way or the SPAC way, it tends to be more, I guess the word is a little bit easier to go public via a SPAC. The traditional way, or the old-fashioned way of going public, was very costly and very time-consuming. There's a lot of paperwork, there's a lot of legal work to go involved. There's just a lot of uplift to do so. Whereas with a SPAC, if you go public via a SPAC, the public company is already in place. And in essence, what you're doing now is you're just taking that public vehicle and you're merging it with the private one. So that initial onset of becoming a public company is that much easier. It's a much faster process. It also turns out that historically also the process of being vetted out through the SEC in terms of the restrictions, the requirements, and the things that you need to do to become public are a little bit more lax on the SPAC side. Not as heavily mandated or regulated. Again, that was in the past. Given the enormous amount of activity that's been happening in the past 9 months and the amount of attention that's been given to the SPACs lately, I'm probably going to say that it should be changing or evolving in the near future.
Terrific. That was a great explanation, Jen. Thank you. So when we think about a SPAC, it really has the SPAC itself, right? It has no commercial operations. It doesn't make a product. It doesn't sell anything, right? And in fact, the only assets that it typically has is the money it's raised, right, in its own IPO. So Doug, as chairman and CFO of a newly formed SPAC in tech, media, and telecom space, can you speak about the opportunities and challenges that an investor faces of creating a new SPAC?
Sure can. So just to reiterate a couple of points that Jen made, investors who are buying into a SPAC are buying shares. They're basically funding the SPAC's future M&A activity, but without knowing what firm the SPAC will target. Most SPACs come with a 2-year horizon, meaning sponsors must complete a deal within 2 years, or else the SPAC will be liquidated and the IPO proceeds will be returned to investors. Hence, investors are not betting on a SPAC's future performance as much as they're betting on a SPAC's ability, or more accurately, the SPAC sponsor's ability to identify and execute a merger with an attractive firm within a 2-year window. The benefits of a SPAC vary by type of investor. So I'm going to talk about the 3 major types of investors. And let's start with SPAC founders, who are also called sponsors. Well, it's the same thing. That is those who bring the SPAC to market and decide what company to target. That's what I am with my SPAC. As a sponsor, we gain easy access to capital and the flexibility to deploy that capital as we see fit. Most SPAC sponsors are financial market or investment professionals or esteemed business executives with industry expertise. For sponsors, SPACs are an easier mechanism for raising and investing capital than the old-fashioned way, which would be to raise a formal private equity or venture capital fund. SPACs also present a potentially lucrative exit, since SPAC sponsors receive a meaningful share of equity, normally 20%, in whichever company we merge with. That sounds great. There's downside though. The downside is that if we don't find a company to merge with, we lose 100% of our invested capital, which is typically 2% of the offering amount plus $2 million. So let's call it $7, $8, $9 million. So that's the sponsors. The second type of investors are the so-called public investors. These are those that buy up the IPO shares in the listed SPAC before a merger target is identified. Now, they benefit from the large potential upside of a completed transaction and what amounts to risk-free conditions before any merger is completed. That's because, as Jen said, all IPO funds are placed in an interest-bearing trust account, and that money can only be used to complete acquisitions. Hence, if a deal never goes through, investors simply recoup their initial investment with a modest interest return. Now, the third type of investor are those that actually are investors in a private company. So these are situations where they're not involved in a SPAC, they're just a private company. And for them, merging with a SPAC is an easier way to list on a public stock exchange than an IPO. The traditional IPO roadshow is a long and cumbersome process that involves wooing investors and filing a lot of paperwork with the SEC. Merging with a SPAC is comparatively simple, and the SEC allows financial projections to be provided with a SPAC merger, but not with an IPO. I'll repeat that point because I heard Jen being the voice of doom there that says that this may not be forever, but with a SPAC merger, you can provide financial projections. You cannot with an IPO. Another benefit is that a company's initial IPO price can swing wildly back and forth in the hours before the listing as bankers gauge investor demand. In fact, IPOs are usually priced at the lowest price that an investor would pay. That's why you see the so-called pop that happens on the day that IPOs are actually done. With SPACs, a company's valuation is agreed upon in advance, which offers greater stability to founders and existing shareholders. And the final point for why would you want to go public with a SPAC is that SPAC deals typically price higher than private transactions and traditional IPOs.
Thanks, Doug. So let me ask you this question, right? Since from your explanation, right, most private companies are looking to merge with the SPAC, right? Really want to partner with, they're selecting, right, a company based on that management team, right? They're looking for a management team that has unique skill sets and operational experience, established relationships. So first, can you talk a little bit about how those partnerships are formed, the management team? How do you pull these people together? How did you do that? And then secondly, in an increasingly competitive SPAC market, how does your SPAC stand out, for example, in the industry that you're looking to be?
Well, that's really the key question. In other words, how do you differentiate yourself? And just a level set, according to a Morgan Stanley report I read this morning, there are currently 350 SPACs in the market seeking acquisition targets. So how does a target company decide which SPAC that they want to go with? And the answer to that really is they look at the backgrounds, the experience, and success of the founders. Not only the founders, but the board members who may or may not be founders, as well as advisors. Many SPACs have advisory boards. So those are the most important differentiators and the major selling point with investors. Now, my SPAC is actually in what's called, the SEC calls a quiet period, so I can't talk too much about it, but I will tell you on this issue, our advisory board and board itself includes 7 current or former CEOs. We have the chairman of Caltech University, arguably the top engineering university in the world. We've got the former managing editor of both the Wall Street Journal and the Washington Post. We have 2 Stanford PhDs, and we've got former investment bankers for Goldman Sachs and for Merrill Lynch that are in our group. How do we attract those people? We attracted it by the 2 of us that are really the key founders. They're people that we know. And 2 of them are hopefully even on this call listening in to it as well. So it's really been done through our relationships of individuals that we thought this would be a lot of fun for them and rewarding for them, as well as that they can add value to us. But bottom line, it's all about the people that are involved in the SPAC. That's really the only difference. Otherwise, almost all SPACs are created pretty equal.
That's great. And wow, what an impressive group you put together. So,
I have to add, to that, to what Doug is saying. It really does. The management team of the individual SPACs really does make a difference. I mean, their knowledge, their experience, that really is what makes them stand out when they're looking or speaking to the targets themselves, as well as whoever is behind them in terms of the underwriters. They will also have a very strong influence in terms of eventually who the target that they have is in mind.
Terrific. No, I appreciate that. So, just picking up on a point, Doug, that you talked about, 350 SPACs out there are looking for targets. I mean, according to a recent Wall Street Journal article, SPACs have raised nearly $75 billion this year and now account for more than 70% of all IPOs. They're up 20% from 2 years ago and six-fold increase in 2020 from 2019. So, there's no doubt that there is just a boom. So as our title of our presentation today, what is causing the boom? Why the sudden popularity?
Well, I'll give you a little bit of a history lesson, which may help put it into perspective. So as Janet mentioned at the start, SPACs really have been around for a while. In 2012, 2013, SPACs started to emerge as a poor man's private equity vehicle, where former CEOs and others who wanted to tap into their deal sourcing networks could do it, but to do it again without having to raise a PE fund. Around 2016, big brand private equity companies themselves started looking at SPACs seriously and selling portfolio companies to SPACs, as well as launching their own. Apollo, TPG, and others did that, because they like the favorable sponsor economics, the 20% that I mentioned early on. Then 2 years ago, in 2019, came validation and serious interest from the biggest and best institutional investors, such as Fidelity, T. Rowe Price, Putnam, and others. Simultaneously came a step function change in interest from the bulge bracket banks, the Goldman Sachs, the Morgan Stanleys, the Citi banks, and so forth. And then last year, everything came together full circle with high growth targets, such as DraftKings going public through SPACs, and a whole new pool of potential companies that came willing to go public, because with SPACs, they saw deal certainty and the upside that the SPACs offered. With more recognizable companies now going public through SPACs, also came retail interest last year like never before. With all the participants getting comfortable in SPACs, the volume of SPACs has risen significantly. I've got slightly different numbers than Janet, because I stole them off of Morgan Stanley this morning. But in 2020, there were 248 SPAC IPOs that raised $83 billion, which represent 1/2 of all capital raised through SPACs since 2003. So half of all capital raised through SPACs was done in the last 12 months. You think that's something? In January and February of 2021, there were 189 SPAC IPOs that raised $60 billion. So all of last year was $83 billion. In the first 2 months of this year, there was $60 billion raised. Wow.
Incredible. Either of our numbers, right? To really make you take pause. Those are significant.
Yeah. Mm-hmm.
Jen, did you want to add anything before we go on?
Nope, go ahead.
All right. So the next question for either of you really is kind of going off of what Doug said in terms of the big banks, right? And them cashing in. Investment bank, as we all know, receive fees, right, in exchange for finding buyers for SPACs. And those fees are not as large as what they typically make, right, in traditional IPOs, but obviously the sheer volume, right, of the number of SPACs makes up for that lower fee generation. And so I guess I have a twofold question. What responsibility does the bank have to the average investor? And this really stems from, I don't know if everyone on the call had seen this, but CNN reported that UBS has actually banned its private wealth team from selling SPAC stocks to its clients, given the risk. So then my question from there says, well, doesn't that just leave out the regular investor if we're not trying to get, the private investors, the individuals involved?
So let's talk about the retail investors, like all of us on the call here. Generally, retail investors are left out of the initial IPO. And that's simply due to the fact that the investment bankers who run the offerings want to deal with as few investors as possible, and they want the investors to write multi-million-dollar checks. What then generally happens is that I've read 52 days after the IPO, the warrants and shares separate and trade separately. And Jen, you may want to, I don't think we've introduced the notion of warrants. So you may want to do that when I'm through with this little bit here. But they will separate out so that retail investors can buy either shares or warrants separately, or even continuing to buy the whole unit. And again, I'll leave it to Jen to explain what we mean by a unit here itself. However, most people, once it's in after the 52 days, and these stocks are all listed, these SPAC stocks are listed, so any of us can go on and buy them. The lion's share of investors do not buy units. They buy either warrants or they buy shares, depending upon their risk appetite. The shares themselves are almost riskless, but they don't have a high as return as the warrants, which the warrants can be worthless. So they can have high risk, but also high returns. Jen, what would you add to that?
Yeah, I mean, I would agree, definitely. There's a little bit of a difference between the warrants, the units, and the shares. So when a SPAC initially goes public, normally the underlying initial public offering is they're offering to the investor what they call a unit. And all that is it's a unit is a composition of two pieces of securities. You'll have a share, which is a share of common stock or ordinary share, and a warrant. And they will sell to the investor, we will sell you this warrant for $10. And for those $10, you get a share and a warrant. And the warrant essentially represents the right to purchase a share in the future at a set amount. And usually that's at $11.50. So as a warrant holder, you're banking on the fact that if I buy it now, in the future, when they have this target company, their share price should hopefully be greater than $11.50, so that when you present your warrant to purchase that share of stock, you're going to pay $11.50, but it's actually worth $20. So you're in essence buying a share of stock at a discounted price. That's your reward for investing and doing it and purchasing it now, because you're hoping and anticipating that the share price will go up even more in the future. Whereas with a share of stock, you buy it at $10, but there's no downside there. What you have in the future is if the share price goes up to $20, you can sell it at $20. Whereas if you have a warrant, you can buy a share at a lower price and hold on to it. And initially also have that initial share that you purchased at $10. So buying a unit gives you almost like a double advantage, because you have a share at $10, which you hope will be higher in the future, and you have a warrant as well, which you can buy a share at $11.50, banking on the fact that the share price will go up in the future.
And not to overcomplicate what's a complicated situation, the rule of thumb these days is when you issue the unit, you don't issue a full warrant, you issue a third or a half of a warrant. But when you buy them on the stock exchange, they're actually assembled so that they're assembled into one full unit. So that probably everyone's eyes glazed over, I'm sure, when I went over that, but it is an important point.
Yeah, that is true. That's true. You'll see a lot of times is they'll sell a unit and it'll comprise of one share of stock and a third of a warrant, or an eighth of a warrant, or a half a warrant, or whatever it is. It's not as common these days to see a full warrant with a unit. It's just, and what comprises a unit is really, it's based on the investor's appetite. So the underwriters prior to going public will do what they call testing of the waters, and they will go out and put out there the potential SPAC and the potential offering that they're looking to do without setting anything in stone and without committing to anything. And they'll get the investor's appetite. And the investors will come back and will say, yeah, that sounds good, but a half a warrant for this type of SPAC, maybe not, or a third of a warrant, whatever it is. And then at that point, the investors will go back to the company and say, for the offering that you're looking to do, it's probably best if we do a third of a warrant, an eighth of a warrant, one share, one unit, whatever it is, and we adjust accordingly.
Terrific. That was very helpful. I think for everyone on the call to really understand really the nuances of what they're investing in. So, SPACs aren't without their critics, right? And Carson Block wrote recently in a Muddy Waters research, and he referred to SPACs as the great 2020 money grab. And I'm going to quote, he writes in the article, and I quote, "A business model that incentivizes promoters to do something, anything, with other people's money is bound to lead to significant value destruction on occasion." And Lloyd Blankfield, for those of you that don't know, the former CEO of Goldman Sachs, reportedly also said that SPAC sponsors, who are mostly tasked with finding a workable acquisition, which Jen and Doug, you just spoke about, within those 2 years, are not necessarily looking for the best possible deal. They're actually incentivized to avoid, they're not incentivized, rather, to avoid overpaying for a target company. Do you agree with that? Disagree? What's your thoughts?
Well, there are different types of SPAC sponsors, founders. They're the ones I like to think of myself as someone that's really spent a career in financial services. I'm with a prominent Wall Street firm today, and what have you. And I think most days I know what I'm doing here. A lot of the SPACs that are out now, particularly those with celebrities and professional athletes, and so, I've got to shake my head over, what do they know about this? This is pretty sophisticated stuff. So I would say for those SPACs that are really just in it for the money, and I shouldn't characterize celebrities and athletes as being just in it for the money, because there may be other motivations, but there's certainly a lot of SPAC sponsors that are in it to make a quick buck. And there, I agree with Lloyd Blankfein that they absolutely could overpay, because keep in mind, if they don't have what's called a de-SPAC, that's a merger with a private company, then they not only return all the money to the investors, but they lose the money that they put up to get it started. So I do think that's a real risk. However, keep in mind that the shareholders, back to these public shareholders, back to Fidelity and T. Rowe Price and Putnam, these are highly sophisticated, intelligent investors and so forth. They get a vote. So when the SPAC says, well, I found this company and we think it's worth X, the shareholders themselves get to vote on whether or not they stay in to the thing. So if you're going to overpay a lot, you're not going to have the support that you need to actually to do the deal itself. So there is a check and a balance, I guess, is what I would say relative to this.
Yeah, I would agree with what Doug is saying. I mean, it really comes down to the knowledge and the experience of any sponsor group that you have in a SPAC. When it comes to investing in a SPAC, I think it's so important to look beyond the numbers and the industry, but to look at the management team itself. How educated are they? How experienced are they? What do they really know about the industry, and what kind of connections do they have in order to be able to find a target? Because you don't want to invest in a SPAC that eventually will be de-SPACing, because then all in essence you're doing is putting your money in a SPAC, and it's in essence like a CD. You're investing it, and all you're going to get back at the end of 2 years is your initial investment plus a nominal amount of interest. So why even bother doing it? You want to invest in a SPAC that really has a good backing from the investors, as well as the underwriters and the PE firms behind them, because they are all going to be working towards finding that appropriate target at the right valuation. And like Doug says, also, it comes down to the initial investors having the ability to vote for or against it. They can vote for it and then pull out, because you will always have that option at any point in time where there's a proxy vote to be able to determine if you want to stay in or stay out, regardless of how you vote. So at that point in time, if you really feel it's not a good investment for you, you can leave and you get your initial investment plus that nominal amount of interest as well. But again, I would go back to look at the management team, look at the underwriters, look who's backing it, and look at their experience, because that is key in determining whether you believe that an adequate acquisition or target will be able to be found.
No, that's great. And, the SEC actually just came out, right, cautioning investors about, Doug, those celebrities, right? And thinking just because there's a celebrity, right, backing, part of a SPAC, that they're a good investment. And so I appreciate your advice to our young investors on the call who may want to jump into this craze. And, I think, Jenn, you explained that really well. Doug, do you have any advice for young investors?
Yeah, I would say, if I were you, I'd sit on the sidelines, unless you are investors in a fund run by a credible firm, such as, again, Goldman Sachs or Morgan Stanley, or a prominent hedge fund such as Pershing Square. Now, if I haven't convinced you, if you still say I'm going to gamble my tuition money on a SPAC investment, then my advice is to invest in the shares of the SPAC itself rather than the warrants, because that way you've got the ability to get your money back. But if it's warrants, those things could be worthless if there's no de-SPAC transaction.
Right. Yeah, that's absolutely true. I mean, if you invest in the warrants, the risk you're taking is if there's no acquisition, you lose it. The warrants become worthless. Whereas at a minimum, if you invest and purchase the shares, you get back your initial investment of your $10 plus a little bit of interest. So at a minimum, that's what you're going to get back. So from an investing point of view, like Doug says, if you want to gamble with your tuition money, your lunch money, or your meal plan money, I would say lean more towards the shares, because at least you're somewhat protected. But again, do your homework, because investing in something just because it's a celebrity or because it's a well-known political figure or anything to that effect doesn't guarantee anything. You really want to take a look at who is behind it, and even for the people who are behind it, whether they're well known or not, you still want to make sure they're in the right space for who they are. Some firms may not be very well known in whatever industry they're looking in, the biotech industry, the healthcare industry. They may be very well, positioned for a fintech type of industry. So it's also that, that homework that just like you would do with any investment that you would do. You really want to do your homework and understand what you're investing in.
Great advice. So I guess my next question really just, again, going along those lines for our young investors, there's no doubt, right? There's this huge surge in activity. Is it a bubble waiting to burst? What is it that caused institutional investors to be so much more receptive to SPACs, today than they were 2 to 3 years ago?
Yeah, but I'm going to try to make a case that there are actually not too many SPACs. And this is me talking to all of you, me wearing my SPAC hats. Would I rather have fewer SPACs rather than more? Sure, less competition, but at any rate. So the case I want to make is that I think you're all probably aware that there are many fewer public companies today than there were in the past. So if you go back to the mid to late 1990s, there were actually 8,000 companies that were public. By 2016, according to Credit Suisse, that number got down to 3,600. So less than half as many public companies. Today, there are about 6,000 that trade on the New York Stock Exchange and the NASDAQ added together. So the questions are, at a time when going public is starting to be in favor again. It's gone from 3,600 to 6,000 or so. What's going on here? And is that a bubble? Or is there real secular value creation that we're witnessing in the economy? And I would say that if you do the math, and let's say there's nothing magical about getting back to 8,000 companies, but if you've got whatever it is today, closer to 6,000 companies, there's certainly room for growth. And since, as the point we've made several times, the SPAC doing an IPO through a SPAC has a lot of advantages to it. I can make a case that the world can really absorb the 350 SPACs that are out there right now.
Interesting. Jen, what do you think?
It's hard for me to agree, only because of the fact that the enormity or the amount of SPACs that have come into light in the past 6 to 9 months has been incredible. But I guess, if you look at it from a global point of view in terms of the number of public companies out there, then yes, obviously that would make sense. But the number of companies that are doing it or going public, as a SPAC has been incredible. I mean, the spike in them has been unbelievable. I've often asked the question, to legal, to underwriters, to the auditors, to management, what is causing it? What is out there? And you get all sorts of different answers. It's, well, you have a lot of the millennials who have the extra cash, and during the COVID pandemic, they were home, they didn't have anything to do, so they decided to start a SPAC. Then you have the equity funds, the PE funds, that again also had all this extra cash, and they are now looking to do more SPACs because they need to invest their money. They have a budget, they need to do something with it. So there's so many different explanations and reasons that you see out there for the spike in SPACs. And at the same time, I ask the same question: is this going to last? And if it is, how long? Because I can only go for so long, working 24/7. I mean, this is unbelievable. And again, I hear the same thing. It's, some people say, yeah, it looks like it's softening a little bit, and the market looks like it's giving a little bit. But then I hear, yeah, it should be like this for probably the next 6 to 9 months. So it's, nobody can really predict. Do I think it'll slow down? I do. Do I think it's going to burst and all of a sudden they're all going to be gone? No. I think at a minimum, it'll slow down, and it'll be somewhat of a leveraged pace, and will be a little bit more stable. So you won't have, 1,000 SPACs coming out every week, but it will slow down at some point, and it'll be more manageable, and it'll be something that'll be a little bit less hectic. And I also think with the SEC starting to notice it, that'll also cause some type of slowdown in the SPAC market, because they will become more involved. They're going to start scrutinizing them a little bit more, and there'll be a little bit more regulation. So it's going to cause people to kind of step back and to kind of see what's going to happen. How is it going to affect the market as a whole?
Jen, can you comment a little bit further on the SEC in terms of, and I know I'm asking you to look into a crystal ball, which is probably unfair, but just because you're such an expert and you're, as you said, working 24/7 in this space, what are you anticipating? Do you think they're going to make changes to disclosure, reporting, timing? What do you think the SEC is going to do?
I think a little bit of everything, actually. I think the SEC is going to start taking a look at it, and they're going to try to rein it in just a little bit, only because of the fact there's so much going on, and the SPACs are coming out, and they're trying to get into the market and go IPO so quickly, and they're bombarding the SEC, and they're feeling it just like all the other providers are feeling it. There's a lot of activity, and there's not enough people. So they're going to at some point say, hey, you know what? We need to slow it down a little bit. We need to take a look and see what's going on. So I think they are probably going to start looking at it in terms of disclosures, in terms of reporting, in terms of the risk to the investors, because again, they're going to look at it in terms of how can we protect our investors to make sure that the risk for them is minimized. So I do believe that they're going to start looking at it in terms of disclosures and the reporting requirements that are out there. Do I feel that they're going to do anything drastic? I don't think anything drastic will come of it. I think it's just more of refining what's already out there and being a little bit more clear in terms of their guidance and what they expect. I mean, we've seen it a little bit already in terms of some of the rules that they've come out with. Nothing, again, egregious or anything crazy, but they are trying to put a little bit more definition around them. And in terms of actually going public, what I have seen during the process of you going public and doing your initial registration statement, the SEC has a period of time where they can actually give comments. So you submit your registration statement, you tell the SEC, we'd like to go public. This is what our deal is going to look like. And they have 30 days to comment on it. Then once they come back after 30 days with their comments, you then resubmit your confidential filing. And then they have another, I think it's 15 days to comment on that. Usually in the past, they would never take the full amount of time. They would, get it and then pretty much turn it around. Now what I've been hearing is the SEC is pushing back and saying we're taking the full time, regardless of whether it's one question that we have or whether it's something that's so minimal. They're taking the full time because they are very overloaded and they have a lot of filings that they need to get to. So now they're pushing back and saying, you know what, we can't be as flexible as we used to be. We have a window of time. We're going to take that time. And I think that's where they're going to start looking at things a little bit more as well.
So Jen, does that result in less SPACs or will the money go somewhere else? Or do you think they're still going to be as popular?
I think they'll still be popular. I just don't know if it'll be as hectic in terms of having that much volume in new SPACs. So yeah, I think it'll be a little bit of a slowdown, but again, nothing that's going to say the SPAC market is dead. It's just going to be a little bit more slower in terms of new SPACs coming in.
Okay, great. Doug, did you want to comment on what SEC?
No, I agree with Jen. I think particularly this notion about providing forecasts versus not being able to, that's one that I think that I know they're looking at right now. It's been reported that.
Doug, maybe can you just talk a little bit more about that? Because I'm not sure the students necessarily understand what you mean by a forecast.
Well, when you do a merger of companies, it's common. I'm not sure if it's a legal requirement or not, but the investors want to really get some justification for why you're proposing the merger. The two companies are proposing it. And one way that you do that is you provide a forecast that shows, among other things, what are called synergies, which mean the added value you get from putting the two companies together, either through lower cost or through additional revenue that will generate. And so in that case, you can actually put out a forecast of numbers and so forth of what you believe the future is going to look like. In the case of an IPO, though, you're prevented from doing that. You can have historic numbers for sure, but you can't essentially put forecasts out there.
Great. I think that really helps. And so I'm going to open it up to everybody. I'm just going to ask one more question. And then because, as I said earlier, we had some technological difficulties. And so we don't have a chat function. So we're going to have to go the old-fashioned route and raise hands. So when we get to that point, I'm just going to ask you to be patient with me as I scroll through and find hand raises. And then I'll call out your name. And I think Ariella has to unmute you. So it'll be a little bit clumsy, but we'll get through that. So if you have some questions, start thinking of them now. But before I go to all of you, let me ask one last question. In the last 2 to 3 weeks, we have seen a sell-off in SPACs. And so I'm just wondering, what are you thinking about in terms of the recent rise in interest rates? Do you think there's an impact on SPACs? Does it make them less compelling?
I don't think interest rate. I mean, they've been historically so low anyway that has much to do with it. I think the sell-off is just a bit of exhaustion that's going on right now with investors. There's so much that's happened. And I gave you the numbers in January and February, and I think it's just the market itself is taking a breather.
Yeah, I would have to agree with Doug. I think that's pretty much spot on what he's saying.
All right, terrific. All right, so let me open it up and I'm going to look for hands raised. And Ariella, if you can help me. Oh, look, I see Bob Mayer. So let me go to Bob because he's another one of our advisory board members. And we're always so thrilled when they can join us. And Bob, we thank you for your continued support of Zarb and for being on the call today.
Thank you. Doug, there's direct listings, there's IPOs, and there's SPACs. Can you explain to everybody the difference in the holding periods for the investors An IPO, they have to hold it 180 days. I'm talking about the inside investors. And there are different holding periods for the SPACs and the direct listings.
Yeah, Jen, you'll have to help me with because this is my first SPAC. There's definitely a holding period. I want to say
Yes.
6 months, but I'm not sure. What is the SPAC?
Usually for the SPACs and the founders, you do have a holding period. I believe it's you have to hold it for I think it's either 6 months to a year after a business combination, and or I think it's usually 6 months to a year, if I'm not mistaken, after the business combination that you're required to hold on to them.
Yeah, yeah. And if it's an IPO, I've gone through 3 IPOs in my life, and that's typically either 90 days or as long as 6 months that you have to hold your shares. And direct listings, I've never gone through one of those. I know what they are, but I've never gone through, so I don't know what direct listings might be.
Terrific. Thank you. Yeah, Bianca, I see you have your hand raised.
Yes, hello. Thank you guys for speaking to all of us. I was just wondering what information could make a forecast more credible or accurate or like effective in portraying that future prediction?
It's really, I think, a question of conservatism versus not anyone. Lord knows I've done more financial forecasts or been part of them than I could possibly count through the days. And you know how aggressive you're going to be relative to the assumptions that you use. But what makes up a I mean, there are so many different factors. One is there's kind of the historical performance, but the other is what do you have contracts already that you've booked that just haven't been fulfilled yet, that you're going to recognize revenue later on. If you've got new product introductions, that's of course where you really have, I don't want to say no idea, you'll have hopefully some idea of what the market receptance is going to be to all of that. Whereas an investor, you need to be really concerned about is the proverbial hockey sticks. In other words, if the company has grown, let's say revenues at 5 or 6% for the last 4 years, and suddenly there's a forecast that shows it growing double digits or 20% or something like that, that's trouble. And for those of you that have taken security valuation, you know that the dominant factor in determining the value of a company is going to be the terminal value. What number you apply to the terminal value and so forth. So if that has an implicit high number, a number that the company's not really generated in the past and so forth, run for cover, stay away.
Yep.
Terrific. All right, we have another board member on and one of our professors in the finance department, Paul Bajorby. So Paul, what's your question?
First, Doug and Jen, this is great. So thank you for sharing with all of us. My question is around equity raising around an acquisition or around a de-SPAC. My understanding is a lot of de-SPAC transactions will require new equity to be raised in order to consummate. Can you talk for a minute about what that process looks like and how important that is to the success of a de-SPAC transaction?
Yeah, Jen, why don't you take, we're now in the world of pipes. So we've introduced warrants and units and sponsors and all these new terms that right now we're going to talk about pipes. Jen, can you do the honors on that?
Yeah, so with the pipe, I mean, what in essence it is you are correct that a lot of times at the de-SPACing process, what happens is you enter into an agreement to purchase this target company and you need to pay a certain price for it. And sometimes, more often than not, what you have in the trust account, those proceeds that you're holding on to is not sufficient. So then you need to go out and you need to do an additional raise in order to be able to fund that acquisition. And that's normally done through what they call a PIPE, which is a private investment or a private placement of investment securities. Usually it takes the form of additional shares of stock. So the company will actually say, we'll issue $100 million worth of additional common stock at a price of $10 per unit. And then that will, or $10 per share, that's your pipe. That's what you're going to bring in. So it is something that is pretty common these days in terms of the equity raises. To be able to do that, again, it comes down to who the backers are, the sponsor group, their ability to be able to bring in additional investors who want to do that raise. And they'll look at qualified investors, institutional investors, people that they know within the market. That's where the underwriters come in as well. And they really do show their value because they are very huge in helping the companies assist in searching and finding those additional investors to help with the pipe itself.
Couple points I would just add to that. PIPE stands for Private Investors in Public Companies. I don't know where the E came from. Some Wall Street person probably thought it was catchier to call it a PIPE as opposed to PIPC. But at any rate, that's what it stands for. And another point I want to make is that when a company does an IPO or does a merger with the SPAC, they are not selling 100% of the equity in the company. They're typically going to be selling anywhere from 25 to 30% of the equity itself. So let's say you've raised as a SPAC $200 million, and somebody wants to sell 25%. Generally, they're going to have a implied market valuation of 500 million or greater. Really, just for the math itself to work in that. And I had another point, and I can't think what it is right now. I'll leave it at that.
Terrific. Thank you for that.
Okay.
Savannah, I know you have a question.
Hi, thank you so much for coming out today. I just was wondering how Mrs. Calabrese mentioned that the SEC will likely become more involved with SPACs. I was wondering if you think this is beneficial to investors for their protection, or if you think it's the investor's job to do their own due diligence and research.
I think it's both. I think really it's incumbent on each investor to do their own research because it's your investment that you're making, and it's a risk that you're taking. So you need to make that investment of your own time to really do that due diligence. But at the same time, I also think that it's beneficial for the SEC to come in and also provide some guidance, because no investor is 100% savvy and knows everything. Neither does the SEC either. But they're there to assist you in terms of being able to provide you the protection as much as they can by requiring the companies to provide the information so that you can make an informed choice. So yes, I do think it's beneficial for them to be there, but too much oversight can also be too much. So there's a balance that needs to be drawn as well.
I just remembered the point I couldn't remember before, so I'll make it that. So we were on the issue of why would a SPAC not have enough money in the trust account to actually consummate the merger. And one reason I was trying to basically say is because the valuation is just bigger than what the money has. But the other thing that what's going on here is the hedge funds have figured out all of this. And very often the hedge funds are in it for the warrants. And what I mean by that is the hedge funds will withdraw their money. They'll the money that's in the shares and only just retain the warrants itself. And I'm told that can happen to 40 to 50% of the invested capital. So it's a big deal that can happen. And therefore, I'm going to say in the majority of the cases, I don't really have the facts on this, but my sense of majority of cases, when there is a de-SPAC transaction, there's also a pipe that has to happen.
Yeah. Mm-hmm. Yeah, and to that point, you're absolutely right. Doug, that will definitely be something that you see. To the extent, again, kind of going on what he was saying, the money that you raise in an IPO, it goes into this trust account, and that money sits there until the point in time where you have a vote in order to approve or not approve a SPAC, a de-SPACing transaction, or an acquisition itself. As an investor at that point in time, you have the ability to withdraw your money and to walk away and take your money with you. So if you do walk away, that's less money that's in the trust, which means it's less money that's available for the company to ultimately use to purchase that target company. So that's where the pipe is important, and that's where it comes in also to make up for that difference and then make up for the additional amount that's needed.
Terrific, thank you. And our own Vice Dean and Professor of Finance, KG Viswanathan, has a question.
Hi, Doug. Hi, Jen. Thank you for your presentation. So my question relates, by the way, I do a lot of teaching and work related to international finance. So this is more on the international side. So is the SPAC phenomenon, is it unique to the US markets, or are there other countries where you also have something similar to what we have here?
Yeah, I literally just asked that question myself last night to our underwriters. I said, is the money that's invested in the SPACs just from the US? And the answer was yes, the vast majority of it is. They didn't have a figure, but the way they answered the question was something like 90% or so. But also, to your point, there's no reason why it has to be limited to either US companies to do the de-SPAC transaction with, or to get the institutional investors. There's plenty of big institutional investors around the world, sovereign funds and so forth, that can get into this, and I'm sure they will at some point here.
Yeah, you do see a lot of investors. The majority, like you said, Doug, are US-based investors or US-based SPACs with the management team in the US. But there are a lot of SPACs also that are out there that are international, that list on the US. So for example, Hong Kong, China, Europe, they do have a presence in the SPAC market. They do have SPACs, even though they're Hong Kong or Europe based or whatever it is, management team, they will actually be publicly listed in the US. So they are considered to be a US SPAC, but their roots are actually international. So you'll see a few, like quite a bit of those as well.
Thank you.
Terrific. Matt Templeton, you have a question.
Yeah, so I just have a quick question on like who's really paying for this 20% like promote fee to the sponsor, since like the target companies already know that they have to give up that 20% of shares to the sponsor. Wouldn't they price in though that into the shares when they're negotiating how much their shares are going to be issued to the SPAC? And won't that just bring down the fee to them, bring the fee to the investor, making them get less shares for the amount of capital they really invest? So like basically I'm asking who really is paying for the promote to the sponsor?
Yeah. Jen, do you want to start with that, and then I'll pick up on that?
Sure. I mean, I think the initial investment it's actually paid for, but well, physically paid for by the sponsor. So they will put in that initial investment to get that 20%. But ultimately, that same group usually is also the same group that provides the working capital for funding the company on a go-forward basis. So you have that initial investment that, yes, gets you that 20%, but then they make up for it with their private placement offering, which will help fund the company going forward. And then ultimately, yes, when they do the de-SPACing and start discussing the terms, the value of those shares do come into play in terms of the ultimate price that's going to be paid.
Yeah, but so that was a very good question, sophisticated question.
Yeah.
I might add too, by the way. At the end of the day, though, the dilution associated with these shares is going to be borne by the other shareholders in the de-SPAC transaction itself. But it's not really 20%, because remember, they're not selling 100% of the company, they're selling 25 or 30%. So the real implied dilution is going to be 5 to 7 to 8% of the shares. But that is the and it's the other shareholders that are essentially paying for that. Now, you also said, well, isn't that priced into the deal? And to an extent, you're right. I'm sure it is. So what he means by those, if you say, what are we talking about priced in? What it means is that the valuation for the de-SPAC transaction, instead of let's say being at $1 billion, it might be at $1.1 billion. That's what he means by the term pricing it in.
And Matt, you're one of our Smith analysts, yes?
Yeah.
Hey, that's why he asked those sophisticated questions. Good for you. And we have another question, and forgive me, Rich J. I'm thinking it's Professor Jones, but we're not able to see you, so I'm not 100% sure. But please ask your question.
Hi, Janet. Yeah, it's me. Yeah, I can't go on my camera because I'm sort of rushing around doing some things around the house. My big question, first of all, I'm glad you're both accountants or have accounting backgrounds because I teach accounting. And my question in that light is really about the governance issues, particularly during the 2-year period while the sponsors are looking for an investment. Are there mandatory meetings between the sponsors and the investors? What are the reporting requirements? You know, is it quarterly? Is it annually? And also, what voice do the investors have in the operations of the SPAC during that 2-year period, particularly? So, what are the governance issues?
You got, but Jen's got, you take it. You're working with 170 SPACs or so right now, so who better than you to answer that?
Actually, they do have required reporting requirements because of the fact that they are publicly listed. They are actually also required to do the same exact reporting requirements as any other public company. So they will have their quarterly filings and their annual filings that they have to do with the SEC. They are required to have reviews. They're required to have audits. The auditors are required to have their mandatory communications with the audit committee and with management as well. So all of the requirements that any public company has, the SPACs are also subject to those requirements itself. With respect to having communications with the investors, that again, it's also the same requirements that you would have as a public company. To the extent that you have something that's significant that needs to be disclosed or reported, they are required to do so. You're not required to have press releases. You're not required to have quarterly earnings calls. Just like any other public company is not required to. Can they do that? Yes. Do they do that? I don't think I've had any of my, over whatever number of SPACs, actually do quarterly earnings. But they do, once they do get closer to finding a target and actually announce the potential acquisition, then you'll start seeing a lot of activity in terms of a lot of discussions and a lot of filings out there. So they'll start doing their press releases and start promoting it and discussing it and allowing the investors to be on call so that they can hear about that potential acquisition.
Are they also subject to Rule FD, full disclosure, the Reg FD? We have to, equally disclose to everyone the same thing, so that, okay.
Yeah, I want to make a point on governance. So the board is required to have a majority of quote unquote independent board members. So most boards are either 5 members or 7. Mine is going to be 5, of which there are 2 of us. I'm not considered independent, nor is my other partner in this, but the other 3 are considered to be independent for it. And we do have 2 committees. I think it's a legal requirement. So we have an audit committee, which also has to be made up of the independent board members, and then a nominating and governance committee itself. The third committee most companies have is a compensation committee. I don't know if SPACs ever have those or not.
Yeah, I haven't seen them on them. I think they may say they have one, but I've never seen them actually hold a meeting, because the officers of a SPAC 99% of the time are not compensated. So when you're an officer of a SPAC, you're in essence working for free.
Well, free, but you're granted equity.
Yeah, exactly. You have the founder share. So the founder share is your compensation for the time that you're going to invest for that 2-year period. But over and above that, there is no salaries. There's usually no payroll or anything to that effect. Some of them may have it, but it's unusual, more the exception than the norm.
Yeah.
All right, so I'm looking at the time, and I think we probably have time for maybe one more question. And I don't see a hand up, so I'm going to ask one, because I get asked this a lot from our students, and I know many of our finance professors on the call do. A lot of our students, especially our finance students, would like to get into investment banking. And now there's actually, they're hiring around SPACs for IB. And JP Morgan's is going to open up their applications for summer 2022, April 1st. can you provide some tips for our students on how to best position themselves to get into that very competitive world of investment banking?
Well, it is competitive, no question about that. And my experience has been that investment banks are looking for students that have really 4 types of skills. One is that they can demonstrate it: intellectual abilities, analytic skills, communication skills, and then management and leadership skills. So intellectual, analytical, communications, and management and leadership skills. If you can't demonstrate those, and I say demonstrate, meaning point to why whoever you're interviewing with should believe those, you're not likely to get a job in investment banking, certainly not with the premier firms itself. Now, the good news is for those of you that are not graduating seniors, you've still got a chance to work on those and to do it through joining campus clubs, through what you major in, what outside activities you do, whether you can, go out and get an internship. All of those kind of things are the activities that you really need to develop to go after it. So that's, Janet, the way I would answer that.
I think it's great advice. Jen, I don't know if you want to add anything.
Yeah, I would agree with that. I definitely think, those are the core qualities, the competencies that you want to show that you have and that you've mastered. Again, the best way to do it is to get involved, be involved in the school, be involved, in your community, show that you have an interest. A lot of times you may not be afforded to be able to specialize in something that's within your actual field of study, but it doesn't matter. If you can show that you have those qualities in something that's totally different, that's okay too, because you're still showing it. It's just that not within that field of study. But me, when I do my interviews, and I've done so many of them along the years, I look beyond the piece of paper. I very rarely look at the piece of paper itself. To me, it's that face-to-face, that interaction. What can you display to me? What can you explain to me? Your communication skills. When it comes to actual technical abilities, the actual knowing of the source information, pretty much anybody can be taught that. It's what you do with it that really is what makes a difference.
Great advice. Well, this has just been terrific. And, I want to thank all of you for participating. It's so great to see so many of our students and so many of our faculty, from probably one of our newest faculty, Professor Costa, to I guess I'd probably be one of the oldest faculty, but I don't want to say that. But anyway, I think it was a terrific discussion. Doug, Jen, we can't thank you enough for sharing your expertise, your advice, your guidance. I think this really helped educate our students on kind of this new world that's getting a lot of publicity. So we appreciate your time tonight, and really thank you again for joining us. And I wish everybody a good evening. Stay safe. I guess I don't have to say drive home. Most of you are. So enjoy the night.